Hello everyone and welcome back to another video. Well, in less than 24 hours, we will see big key economic data come out of the US markets. And in today's video, we cover the stock, crypto, and commodities markets and what we may have as some key next levels for this in what is expected to be a bit of a breakout session. We're at the resistance here for the SP 500. We've filled the first gap, but we've created another. Will the bears come back? Stay tuned to find out more. All right, everyone. Well, welcome back to our market recap here for the 9th of February, 2022. And if you're interested in anything to do with the stock, crypto, or commodities markets, please make sure to subscribe and, of course, give the video a big thumbs up if you do end up enjoying it. Disney booms back to where it started. Now, Disney basically had a good earnings. We saw it go up upwards of around 8% after hours and climb around that level. We know sometimes after hours can't hold, e.g. Amazon, but it was a decent result and was led by things like the Star Wars franchise, Marvel, etc. The thing that really was the story of the day, though, was not just that the earnings were good, and they are still beating to a big degree. Remember, it's forward guidance that really the market's worried about now. It's not a question of whether this was a good quarter. It's a question of what's happening for the rest of the year. But we have technology coming back in a big way. Semiconductors were up huge, led by that NVIDIA, 6.36%. Amazon struggling after the big earnings result, pushing it back into that resistance area. And Tesla still in a coil. We'll be taking a look at that because Tesla traders will be really anticipating a breakout soon. And remember, there's plenty of opportunity in these markets, regardless of whether you think you've missed out on the dip or anything like that at this stage. We still expect a very volatile period, and we'll use some data to show you that soon. So let's have a look here at the Nasdaq, Russell 2000, SP 500, and Dow. You'll notice the Dow was lackluster. The Nasdaq and IWM were bulling into the close. And in general, it was a risk-on day, pushing towards that resistance on the SP 500. It was interesting to see some of the sectors that were going off as well. We had solar, TAN up as much as 6% in the open. Semiconductors were up 3.48, and one of our favorite recovery plays at the moment, Jets, up a further 2.71, just solidifying how good that pattern that we looked at in previous videos has been. And if you want to, you can go and check those out. They're definitely worthwhile having a look at these sectors. Let's talk about seasons, though. Let's talk about seasonality and the year that we're in, because we've often thought 2022 was going to be the year of the trader and investors pinpointing key levels. It's never an easy year in these cycles, and that's because of the midterm elections. And if we take some parallels with 2018 and 2014, what do we tend to see? Well, we tend to see a pretty big weakness in January, and that leads and spills over into the first quarter of the year. This stat holds up for a long time as well. It actually holds up all the way back to the 1950s. So there's about 70 years of data that really pinpoints midterm election years tend to have weakness here and sometimes considerable weakness throughout the year with very little returns, and then sometimes a very, very nice bounce after that period. So based on this chart, we would expect some weakness through that January to March, possibly an uptick, followed by further weakness in the third quarter, and then maybe some fourth quarter pickup. And that's some great stats, but let's have a look here on the chart. You'll notice year two, what we're going to be seeing, roundabout kind of traders market. And then if the stats hold true to, let's say, that last 70 years, imagine if you came in and you saw the right technical analysis, the right base accumulation. Let's say the markets are down 20%. We don't know at this stage how far it's going to go, and you're seeing a turnaround. Would this be a time that you could be interested in? Absolutely. Remember, it's technical analysis first, price action, understanding the psychology of the markets, and the data helps you kind of solidify that and give you a little bit of confidence. In terms of data, the beat rates here are still really good, 75% beat rate. And in any other quarter, you would think this is an amazing result to be holding up so much. 609 beats, 208 misses. Some high profile misses, but in general, huge beat rates. And in the last session, we saw Disney do well, Uber do well, Twilio do well, Mattel did okay. These were all pretty damn good results. And now it comes on some of the ones that notoriously don't do well. We've got Twitter, Ooh, I wonder how they'll do. And we've got some big hyper stocks coming out as well. Things like Datadog, Cloudflare, plenty of big profile names still coming through, but we're basically past the worst of it. We'll just quickly gloss over this data. We talk about it all the time. If we have weakness into January and then we tend to see that big rally at the end, that usually leads into a kind of sideways month in Feb, and we need to remember those stats. And something that's just kind of important to understand. But let's get into the technical analysis, and we'll start here with the VIX, the volatility index. It continues to hover around 20. So basically 20 is considered when the bears are in control, and when it's underneath 20, the bulls are firmly in control. It's a bit of an unwritten law throughout history. And you'll notice that generally speaking, the VIX can't stay above 20 for that long. It spikes a lot, but that tends to roll over. And one of the reasons why this is because everyone gets fearful in the markets and they tend to open up huge levels of puts, and then the market goes, no, that's a buy the dip, and everyone that's hedging unfortunately loses their money. We know this was retail hedging hard. The level of small put opens was massive over the January period. There was never a point of larger fear, and we proved that with some charts recently, than what we have seen over the last month. People were hedging hard, and you know what Wall Street hates to do? Pay those people off. And of course, they were all short dated. And what that means is it was only for a few weeks that most people were hedging. They were trying to make money from a bearish market. Now we've seen the PCC, this is the put call ratio, turn around, kind of showing us that there's a decent amount of calls starting to be opened in relation to the puts. So this comes ahead of the CPI data, and we'll continue to talk about this as we go through some more information. The 2-year, 1.365, obviously a 99 point some ridiculous number chance that March will have at least a 0.25 rate hike. Some people now calling 0.5. I think this makes the most sense for the Fed to come in hard and fast, but we will find out that in March. And in general, this is still a flag pattern. So we kind of expect the 2-year to possibly even continue to rise. One of the big signs that volatility is coming out of the market is when this stabilizes and then we see it turn around and actually go back to the negative side. Remember, the Fed will be coming up. The market is already probably extending past, and the real rate is not going to be where everybody expects it. A lot of people think the real rate's 2.5 to 3. I have a suspicion it's more like 1.5 because of the debt level in the systems. Let's take a look at also what the dollar index is telling us. Every central bank around the world is all saying, let's get rid of monetary policy, let's raise the rates, we're going to do it now. And that's putting pressure on the US dollar, and that's a big reason why it is. It's an across the board real concept of taking away some of the stimulus. And when we go into something like a 1-hour chart here, whether you trade the US dollar or not, you'll notice it's got a big resistance on it around that 95.80. So if 95.80 is breached to the upside during this next bit of news, there could be a bit of ramping here from the US dollar, and certainly a big resistance that a lot of people will be looking at. We'll move over to some of the commodities before we get stuck into the indices, stocks, and crypto. And we'll start off here with this particular one, which is gold. Now, we pretty much called here that it was going to go bullish. And gold versus US dollar has been okay. It's had 2 really nice days. We're hoping towards that 1870 kind of marker here for gold, finally taking a bit of a bull move against what has been relatively a pretty weak time for it now, ever since everyone got hyped up on gold well over back in 2020. And I think this is the thing. Gold is good when you trade it. It's not necessarily the best long-term hold like a lot of people think. But just remember, you can trade gold versus a lot of other assets. So something like gold versus yen has actually been an incredible trade in comparison. And this is something that you may want to do. Gold versus euro, gold versus pound, gold versus odd. All these different currencies that you can trade it against. That's how a lot of commodities traders work. They trade it against another weak pair when they get bullish on that sector. And you'll notice that gold yen has broken out of this resistance. And while it might come back down, there's certainly some big key resistance here which could act as support. It's just an interesting way of thinking about things. I think a lot of traders don't consider that. US oil, look, at this stage, it has bounced again. Maybe if there's a follow through, there could be a day trade there, but we've hit the 92. We like that level a lot from resistance. I'm not convinced that oil won't pull back a little bit here and consolidate. And the main reason is its length away from the 20 moving average weekly. When you get such a huge extension away, it becomes an unusual move and the market tends to pull back. So this is at its peak, 17% plus away from the 20 moving average. And we haven't really seen that since the big rallies over here and the previous pullbacks. When we pulled back last time, we were only around 14% away. So this is a fairly large extension here for energy, and it is getting away from itself from that point of view. Let's talk about Tesla. Tesla gets exciting because I'm excited about this chart. It's pretty cool. When we think about the price action, we've got like a hanging man, we've got a rejection candle, we have another rejection candle, and it's all around this 950. I saw a funny comment in, I think it was the comments or the live streams that we do on the close. And one of them was like, don't let Tesla above 950. I've got covered calls. And I think that's probably the big thing here. There's a lot of 950 strikes, 850 strikes, and 900 and 1000. Obviously 1000 being the big one. We have a long leg doji. That basically means a high, a low, an open, and a close. It shows indecision, and it's exactly the type of indecision that you would expect around this point. And I think it opens up the next 24 hours of trade, because think about it. We close above here, then all of a sudden we can move towards that 1000 because we've gone through the 950. We move to the next logical zone, which is 1000, where there's so many calls. Previous support becomes resistance. And if we close to the low here, we maybe go back down, test that 880. And obviously if we get through 880, we've talked at great length about the weakness that could come through Tesla. Tesla's a great day trade when you know what you're looking at. Now, a lot of people say we need to bring back Apple all the time and we bring back Microsoft, and these are the heartbeat of the market because there's such a huge point or part of it. And I agree, sometimes it's worthwhile checking out these. And while the rest of the market has been breaking out, a very good, high quality stock, in my arguments, the highest moat that you can get pretty much in the market, and that is a business that can't be destroyed by other businesses, it's just got such a competitive advantage, is Microsoft. We haven't seen the turnaround to the new resistance yet. So that is a 314 plus close. And that is maybe one of the key things that we want to be seeing here over the next 24 hours if you want to go bullish again. We've got here Microsoft moving up. It's coming off that trend line, off the good result, pulling back. So we've got a trough, a peak, a higher trough, and then do we get a higher peak coming through this zone? Something that I think a lot of traders will be looking at, and also investors, once we get the data and the result. Let's move over to ARK. ARK is looking better than it has done so. Good result from Twilio has led to ARK being up after hours. We've also seen that 20 moving average here, the red line that's posting down, be a huge level of resistance. And will we breach this? We're at the level of resistance. We've obviously got the trend line as the second point. We've got the troughs, we've got the peak, we've got the higher trough. Will we get the breakthrough? The markets are down slightly here in after hours trade. And I think that's just a risk off going into this big inflation number. But yeah, it's really about ARK here at the 20, right on the resistance. Another one that's interesting here is TAN, which is the solar markets. Now, it came out with big force. I mean, we saw Enphase go crazy. It came through, pushed this up above, and then closed right on the 20. Now, a lot of people would think this is a breakout of that declining market that we've been having recently. I don't class a bearish candle, as in a red candle for the day, even with a gap, as a break, a proper break above the resistance. I think it's a bit of a top tip. If it was green, different story. But because it is red, I don't class it as a breakout yet. But this is one of the most underappreciated sectors of 2021. And it will be one of those sectors that, if you get the right price at the right time, could pay off the best for possibly 2022 into 2023. Move over to IWM and the indices. We have here a pretty nice one, being that we've breached to the upside. I don't trust IWM's breakouts that often. I've always said the SP500 is the best in terms of pure analysis. And it's broken out, but we have the previous supports here at 210, and that's going to be a resistance. I mean, if it does go and rally for whatever reason, this level here is the real tester. So even though the base is good, the breakout is fantastic, the problem with the breakout is it goes straight smash in to a massive support that was forming for an entire year. So I think we need to take that one with a grain of salt at this stage. Move over to the Nasdaq or the QQQ, big coil range, came out of the gates fairly strong. There was pretty much a trade here in the futures into the open market if you wanted to take it bullish for the day. Nice gap through, showed that this market was ready to kind of move up for that session and risk on. Now it's less about the Nasdaq really and more about the S&P and the SPY, because when we consider the key levels here, yes, okay, we break through 15.2. That's going to be a big deal. That's going to lead to what you would think is a massive trough, peak, higher trough, higher peak, and a huge sequence there. But we have a gap now that can be filled to the downside. We also know that it's more about the S&P at this stage because it's right on resistance. And at the start of the video, we talked about the gap fill to the upside. That's now tick done. Will we now get a gap fill to the downside and then test? And I think that's probably the most likely scenario over the next 24 hours, is that the market will probably continue to sell off or at least find some weakness. It will come back, it will test that 452, and we're going to find out what the day traders, what the scalpers and the big market makers are trying to do. Because if it gets down to this level, this is where you expect that lightning bolt small time frame, that double bottom, that inverse head and shoulders, whatever pattern it might be, to occur around here to the bull side. If they bust through this zone and they close below, it's going to be relatively bearish. And we've talked about the key level for the real bears to come back in. It's all about down here. This 200 daily sitting at the 443. If that happens, it's back onto bear town, and you better be nimble and fast, because the VIX will go up, the market will get trashed, we'll move back to something like a 430. It just makes a pure logical conclusion, and really a lot of the data will be playing out. Remember, we see an up, down, and all around market. Even a bullish close above here, if you're feeling really bullish right now, we move towards 470. Well, what's going to happen at 470? So much resistance. There's got to be some sellers there, yeah? And then that scenario of maybe it goes up here, pulls back, we see some buyers. If it weakens again, that double dipping that often happens in markets could occur. Just remember, when you go back through history and you think about markets that have rallied, they often do come back down and test when you least expect them. And I think a lot of retail traders don't go back and do their history on these levels. Even this breach here, when it was kind of consolidating, it breached, went up and tested, and then all of a sudden it was right back down there, freaking everybody out only a few weeks later. So I think that's something that we always want to be considering here in markets. Here was a great one that happened obviously in 18, and then what the similarity was here was we saw this big rally, and then we had a big dip back into the support. Remember, this was 18, a midterm year. It rallied back up, it got destroyed, and then the rest is history. There were some amazing gains if you were able to trade through those markets and invest correctly. Well, that really brings us to, I guess, the options discussion here. I just left up yesterday's options. We saw quite a lot of puts. It kind of made us a little bit more bullish for the end of the week because we need some more calls to come in for Wall Street to kind of steal from. That is what we got. We still have this huge put wall sitting around 440. We probably don't expect the market to be able to get underneath there by the end of the week, but calls were being opened, and we've got the kind of that range that we really could trade here for the rest of the sessions. Let's move over to Bitcoin. What's going on there? Bitcoin is continuing to hold itself, but it's going to have problems with 46,000. Until it gets through 46,000, we won't see the general mainstream media and everybody else get really bullish back on Bitcoin again. It comes down to really look at these candles. We have indecision, long leg doji again, high, low, open, close. We've got another kind of indecision candle. We're looking for a 46,000 break. And at that point, you'll see a lot of participation come back in. People that have sold out here and had weak hands will come back in. That's always the stage, always the thing they do. They sell low, buy high. Yeah, that's what you want to be doing. Is that correct? And then we will move forward. So 46,000 is a huge deal for Bitcoin. Ethereum, still got a pretty decent looking trade on it. It just closed above the long leg doji. Maybe this moves to the 3,400 line. That could be quite interesting there. And of course, BTC shorts is continuing to decline. So it's not like the large traders are really showing us that they're scared of Bitcoin. They're buying in. because they're certainly not shorting it at this stage. Yes, Wall Street's in here. Yes, this whale index doesn't matter as much as it used to, but still they're not shorting in droves like they were during the recent crashes. If we go over to the calendar, we were talking about the CPI result. Obviously, this is what everyone's watching. Everyone's aware of it. The market will do whatever it feels like, regardless of the result. I bet you it just does what it was always going to do. We don't know exactly what that is. We're going to follow the price action, be nimble, be quick, and of course, 8:30 a.m. New York time. If you enjoyed today's video, please remember to subscribe, smash that like button, guys, and we'll see you in the next one. Bye for now.